All right, guys, let me tell you something. 2025 is gearing up to be one of the biggest IPO years we've seen in over a decade. Wall Street is calling it an IPO Supercycle. Private companies that sat on the sidelines during the high interest rate storm are finally ready to go public. And investors? They're starving for new growth stories. Now, that sounds exciting. You're going to hear names like Stripe, Databricks, Reddit, Shein, maybe even SpaceX. You'll see headlines screaming, biggest IPO since Facebook. And you know what happens when hype hits retail investors? People start thinking they're about to strike gold just by buying in at day one. But pause. Take a breath. Because here's the reality. IPOs are one of the easiest ways for Wall Street insiders to transfer money from your pocket to theirs. And unless you know what to look for, you're going to end up holding shares while insiders cash out and sail off into the sunset. So in this video, I'm going to walk you through how to think differently. We'll talk about the hottest IPOs of 2025, yes, but more importantly, I'll show you how to analyze them, how to see through the hype, and how to figure out if you're looking at the next Amazon or the next WeWork. And trust me, the difference between those two is massive. First, let's talk about why IPO fever is back in 2025. Remember the last couple of years? The IPO market was basically frozen. High interest rates, inflation fears, global uncertainty, companies stayed private longer because they didn't want to debut in a storm. But now, rates are stabilizing, markets are rallying, and investors are screaming for new opportunities. Venture capital firms want exits. Private equity wants to cash out. And the timing couldn't be better because hype-driven sectors like AI, space exploration, and e-commerce are red hot again. But here's where people make the first mistake. They assume big name equals big return. Wrong. Just because you've heard of a company doesn't mean it's a good investment. Remember Uber's IPO? Huge name, global brand, everyone knew them. And yet, the stock tanked after IPO because the losses were insane. Familiarity does not equal profitability. On the flip side, look at Airbnb. They IPO'd during the worst travel crisis in modern history. COVID had gutted the travel industry. Most people thought, why would I touch this? But fundamentals mattered. Strong brand, loyal user base, great margins. Fast forward, and Airbnb has been a fantastic performer. The point is, 2025 is going to be full of shiny objects. Your job is to ask, is it hype or is it substance? Now, let's dig into the actual names. Stripe, for example. Everyone knows Stripe powers online payments. Every time you swipe your card on a Shopify store, there's a good chance Stripe is behind the scenes. Massive brand, massive revenues. But the question is, are they profitable? Because revenue alone means nothing if expenses are eating it alive. Their S1 filing is going to show us whether they're printing money or just burning through investor cash. And I want you to think about this. If Stripe IPOs at $70 or $80 billion, does the math make sense? Or are you paying for growth that might already be slowing? Then you've got Databricks. This is the AI data darling. Right now, every company with AI in its pitch deck is getting insane valuations. But here's the danger. AI hype creates bubbles. If Databricks shows real enterprise contracts, sticky customers, and strong retention rates, that's gold. If their revenue growth is just buzzwords and smoke, that's dangerous. And Reddit, oh man, Reddit is tricky. Everyone knows Reddit. It's literally the home of Wall Street bets, where retail investors pump stocks and roast hedge funds. But monetization, weak compared to Facebook or Google. The big question for Reddit's IPO, can they finally turn engagement into revenue? If their average revenue per user is still tiny, the long-term case is weak no matter how much cultural impact they have. And Shein is another monster IPO that might hit. Fast fashion beast, billions in sales. But think about this. Regulatory risks, environmental issues, razor-thin margins. Investors will hype it up, but long-term, can they survive the pressure from governments and sustainability concerns? And then there's the nuclear bomb, SpaceX or Starlink. If Elon Musk spins off Starlink, it will be the blockbuster IPO of the decade. Everyone will want a piece. But the valuation? If they come to market at $100 billion or more, you have to ask, is the growth already priced in? Sometimes the greatest companies in the world are still terrible buys at the wrong price. Now, let's pause and get tactical, because hearing these names is one thing, but the real edge comes from knowing how to read the truth in their numbers. That's where the S1 filing comes in. It's boring, it's long, but it's also the only place where companies are forced to tell the truth. When you crack open an S1, here's where you look first. Revenue growth. How fast is it, and is it slowing? You want consistent acceleration, not a curve that's already flattening. Profitability. Are they making money? If not, do they at least have gross margins that suggest they can make money once they scale? Risk factors. This is where companies basically say, here's how we could die. Don't ignore this section. If you see things like, our top 5 customers make up 70% of our revenue, that's a red flag. If you see, we may never achieve profitability, that's another. Valuation. How much are they asking for compared to what they're actually earning? Paying 100x revenue for a company that's slowing down? That's suicide. And then, use of proceeds. Are they raising money to expand the business, or are insiders just cashing out? If insiders are dumping their shares at IPO, ask yourself, why are you buying what they're selling? Let me ask you this. Have you ever noticed how IPO day looks like a circus? Media coverage, confetti, executives ringing the bell. All of that is designed to pump you full of FOMO. They want you to believe you're missing out if you don't buy now. But smart investors? They wait. They let the hype settle. Because here's a stat most people don't know. Many IPOs actually drop significantly after the first 6 months once the lockup period ends and insiders are free to sell. That's when you find out the real value. So don't get caught up in day one mania. You don't need to be first, you need to be right. Quick pause. If this kind of breakdown is helping you think differently, hit that subscribe button right now. Most channels just say, here are the IPOs coming up. I want to actually arm you with strategies to avoid getting burned. So if you want more of that, subscribe. You won't regret it. Now, let's talk about red flags and green flags you'll see in real life. A big red flag, declining revenue growth. If they were growing 50% year over year 2 years ago, but now they're down to 15%, that's a problem. Another red flag, massive cash burn with no timeline for profitability, or reliance on one product, one customer, or one region. That's fragile. Green flags, on the other hand, sticky customers. If existing customers are spending more each year, that's beautiful. Expanding gross margins. Founders who still hold large stakes. That shows skin in the game. And of course, a giant addressable market with room to expand. Now, let me give you a scenario. Imagine Company A is growing revenue at 45% year over year. Gross margins are rising, and the CEO still owns 25% of the company. That's strong. Now imagine Company B is growing just 12%, burning $500 million a year, and insiders are dumping shares as fast as possible. Which one are you going to trust with your money? Exactly. I want you to also think about investor psychology during IPOs. Most retail investors are driven by FOMO. They see headlines, they see friends bragging about quick gains, and they jump in without doing any homework. That's why Wall Street loves IPOs. They know retail money floods in on hype. But guess who sets the IPO price? Insiders. Guess who benefits if the stock is overpriced? Insiders. Guess who's left holding the bag? You. Unless you play smarter. And smarter doesn't always mean avoiding IPOs altogether. It just means knowing your strategy. Maybe you take a tiny position if you love the story. Maybe you wait 6 months to see where the price settles. Or maybe you avoid single IPO bets and use an IPO ETF instead. That way, one failure doesn't wipe you out. Let me wrap this up with the big takeaway. 2025 is going to be a crazy year. Some IPOs will become legends, like Facebook or Airbnb. Others will collapse, like WeWork or Blue Apron. But the difference isn't luck. The difference is fundamentals. Can the business grow? Can it turn a profit? Are insiders betting with you or against you? And is the valuation realistic or just a fantasy? So when you hear the hype, stop. Ask the real questions. Remember, an IPO is not a lottery ticket. It's just a business asking for your money. Treat it like a business. And hey, if you made it all the way to the end, you're not like most retail investors. You're actually taking the time to learn, and that already gives you an edge. Do me a favor, hit that subscribe button right now. Because in the coming months, as soon as these IPOs file their S1s, I'll be breaking them down one by one. Stripe, Databricks, Reddit, Shein, you name it. I'll show you the numbers, the red flags, the green flags, so you know exactly what's hype and what's real. Drop a comment below. What IPO are you most hyped for in 2025? I want to hear where the excitement is. Until next time, don't invest with FOMO. Invest with facts.